Before I start this episode of our Grow It campaign, I want to say a quick thank you to the episode sponsors. They are Wealthify, Invest Engine and Fidelity. I'm going to say a quick bit about each proposition, so make sure you listen to them, because later in the series when I talk about the different propositions out there, they'll be useful to refer back to. Do remember that with investing, your capital is at risk, so the value of your investments can go down as well as up, which means you may get back less than you invest. That is relevant to each of the propositions I'm going to talk about. First up, Wealthify is a multi-award winning online and app-based investment service founded in 2016 and backed by Aviva, with a simple mission to make investing accessible to everyone. You can invest from as little as £1, £50 for pensions. Wealthify has a simple yet competitive annual management fee. Investment costs also apply, and offers a number of investment products, including a stocks and shares ISA, a general investment account, a personal pension, and a junior ISA. Within each of those, you can invest in a range of managed portfolios with varying risk profiles and even ethical portfolios. For more information about Wealthify, please visit wealthify.com/MTTM. Now, Wealthify does not offer advice. If you're not sure whether investing is right for you, then please speak to a financial advisor. Wealthify is authorised and regulated by the Financial Conduct Authority. Moving on to our next sponsor, Invest Engine. Invest Engine offers a low-cost approach to investing with no platform fee if you choose your own investments, or if you'd like a little help, they'll build and manage a globally diversified portfolio to suit you for just 0.25% per annum, or just 25p for every £100 you invest. You can get started with £100, and there is a £25 investment bonus available to new customers if you'd like to sign up via the link in our review. For more information about Invest Engine, visit investengine.com. Finally, I'd like to say thank you to our Grow It series sponsor, Fidelity International. Whether you're just starting out or an experienced investor, Fidelity offers a wide range of investment options with plenty of information, tools, and guidance to help you make more of your money and achieve your financial goals. For more information about Fidelity, please visit fidelity.co.uk/money to the masses. This video is going to focus on answering the question, why should you think about investing? Now, first of all, let's start with the difference between saving and investing. Saving usually means setting money aside into a bank account, a building society account, or even a credit union over a period of time. You then usually earn interest on the money that you have deposited. The rate of interest you earn will depend on the account you choose and the level of access you want to your money, but often the rate of interest is relatively modest. Investing is different. Investing involves buying assets or products in the hope that their value goes up over time, or that they can produce an income. The most common types of investments include company shares, bonds, which are essentially loans to companies, and property. But there are a whole range of other assets out there that you can invest in, which include things like commodities such as gold. When you save money in a bank or building society, the value of your money will not fall, and that's ignoring the obvious risk that the institution fails. But with investing, there is always some level of risk, which will vary depending on the asset that you choose to invest in. But with this increased risk comes the increased possibility of achieving a greater return on your money, especially over the long term, than can be achieved by simply depositing that money into a savings account. As such, investing can also be a powerful tool for building wealth. Of course, the flip side is that the increased risk also means that the value of your investments can fall as well as go up. But investment risk can be managed through a process called diversification, which I will talk about later on in this series of videos. When you put your money in a savings account, the interest rate that you earn is often lower than the annual rate of inflation. Now, inflation is the increase in the cost of goods and services over time. And in the UK, the official rate of inflation is published each month. The reason why inflation is important is because it can erode the purchasing power of your money and therefore impact your wealth over time. When I talk about the erosion of purchasing power, in simple terms, I really mean that your money will be able to buy less stuff in the future. By investing in assets that appreciate in value over time, you can potentially outpace inflation and maintain the purchasing power of your money. If instead you save money into a savings account that pays an interest rate that is below the annual rate of inflation, your money is losing value in real terms year on year. The purchasing power is falling. Investing, on the other hand, can be a hedge against the impacts of inflation. As such, investing can increase the chances that you can achieve your financial goals, as well as the speed at which you do achieve them. I mean, these goals can be anything from saving for retirement, purchasing a home, or funding a child's education. By starting to invest early, you also have more time to let your money grow and compound. Compounding occurs when your returns are reinvested, allowing your money to grow even faster. But investing is not just about growing your wealth. You can also invest to provide a passive income stream. A good example of this is dividend income that's paid out by companies to their shareholders, or if you're talking about property, this passive income is known as rental income. Historically, investing was the preserve of the wealthy or those with a financial advisor, but this is no longer the case, and it is accessible to anyone. This is thanks to a combination of factors, including improved technology, increased competition, and changes to legislation. A good example of the latter is auto enrolment, whereby employers have to pay into a pension for their qualifying employees. It means that millions of people are already investing via their company pension, but they may not even realize it. What investing isn't is speculation or gambling. It's how you responsibly grow your wealth over time while managing risk, which is why you should think about investing. But as I will explain in the next video in this series, there are things you should consider before you start.